Hello and welcome back to Global Payfest 25, our 24-hour journey around the world, exploring the complexities and unique challenges of global payroll. I'm Lewis Roskilly, Associate here at JGA Recruitment and your host for this session. And I'm delighted to continue our event with our focus on India. As multinational organisations continue to expand across borders, understanding the payroll landscape in different countries becomes increasingly crucial. India, with its robust economy and complex regulatory framework, presents unique challenges that require specialised knowledge. Today, I'm thrilled to be joined by Yallappa Shekshindi, an Indian payroll country expert from Remote. Yallappa is an accomplished payroll professional with over 17 years of experience in the industry, an MBA graduate from 2007. He has expertise in end-to-end India payroll processing, compliance, HR operations, onboarding, and payroll integrations. Yallappa has managed payroll for organizations ranging from smaller teams up to 35,000 employees, led Southeast Asia ADP payroll integrations for Singapore, Thailand, Malaysia, and Indonesia, having worked with leading companies like Aon Hewitt, Exide Life Insurance, Accenture, and now Remote. He specializes in aligning processes with rules, regulations, and best practices. So Yallappa, thank you so much for joining us today to share your expertise with our global audience. Could you please tell us a bit about yourself and your experience with Indian payroll?
Yes, Liz, and thank you so much for the detailed introduction, Liz. So I am equally excited to be here. So with over 17 years of experience in payroll, so I worked across various areas, including India payroll processing, compliance, HR operations, and international payroll integrations as well. So currently, I am India payroll risk and compliance expert at Remote. So where I focus on aligning processes with the regulations and the best practices. So yeah, I look forward to share my experience and learning from all of you today.
Wonderful. During our session today, we're covering key Indian payroll challenges, recent regulatory updates, and best practices for multinational organizations. We'll then walk through a practical case study that demonstrates how to tackle complex Indian payroll scenarios. And finally, we'll address some common questions that payroll professionals often encounter. Let's get started with Yallappa's expert presentation on Indian payroll.
Yeah, once again, thank you, Lewis, and I'm very happy to be part of this discussion. And hello to everyone joining us for the Global Best Pay 2025. So I'm excited to share insight into India payroll and help multinational organization understand the unique aspect of the payroll processing in India. So, Lewis, as you know, the India payroll system is governed by the several regulatory frameworks that create a complex landscape with distinctive state variations. So, the India is currently following the multiple labor laws at both central and state levels to manage various aspects of the employment. So these laws are actively in effect today. So the number one comes to the Equal Remuneration Act 1976 and the Minimum Wages Act 1948, Payment of Bonus Act 1965, Maternity Benefit Act 1961, Employees Provident Fund and Miscellaneous Provisions Act 1952, Employee State Insurance Act 1948, Payment of Gratuity Act 1972, Shop and Establishment Act. It always varies by state to state, and Factories Act 1948. While these laws have served us well, but their multiplicity often led to overlapping provisions and inconsistencies. So to simplify things, the government of India decided to combine these laws into four unified codes. So those codes are the Code on Wages 2019, the Industrial Relations Code 2020, the Social Security Code 2020, the Occupational Safety and Health and Working Conditions Code 2020. So apart from these labor laws, we do have the tax regulations in India. So the income tax regulations is governed by the Income Tax Act 1961 with annual amendments through the Finance Act. So, apart from these tax regulations and the labor law, we do have the state-specific laws as well. So, those are the Labor Welfare Fund and the Professional Tax. So, these are the specific states and have different rules and requirement for the implementation and compliance. So, there are a few key Indian payroll challenges. So, the first challenge is India has the multiple social security program. So, under that program, the first comes the employee provident fund. So the employee provident fund is applicable to the establishment with the 20 plus employees and to employees earning below 15,000 per month mandatory. So through many of the companies extended it to all the employees as well. So the employee contribution 12% of the basic, and the employer contribution will be the 12% of the basic salary with some portion going to the EPS. So the 8.33% of the 12% of the basic will go to the EPS, and rest will go to the EPF account. So next comes to the employee state insurance, the ESI. So this is applicable to the employees earning below 21,000 per month is covered under the establishment. So employer share comes to the 3.25% on the gross, and employer portion will go to the 0.75% of the gross. So the other point comes to the gratuity. The gratuity is payable upon the resignation or the termination for employees who serves 5 years of the continuous services. Typically, employees who have completed 4 years and 240 days in the fifth years may be the considered eligible for the gratuity, as this is deemed equivalent to the completing 5 years of the service. So only in case of the death and permanent disability, the gratuity is payable regardless of the duration of the service. So the gratuity will be calculated as is like the last run basic salary into 15 divided by 26 into number of year of services completed. And companies must account for this liability and may choose to fund it through insurance as well. Yeah. So the second key point is the income tax complexity. Income tax calculation and the compliance in India involves like the tax regime options. So in Income Tax Act, we do have the options called the new tax regime and the old tax regime. So as per the new optional tax regime, which lower rates but fewer deductions, the traditional tax regime, the old tax regime with higher the rates but multiple deduction benefits. So employer must calculations for both options, considering a new tax regime as the default regime for the employees who have not acted on the options. So next, the TDS deductions. The annual TDX has to be arrived and monthly TDX to be deducted for the employees, and should file a quarterly return to comply with the income tax regulations. The last comes to the issuance of the Form 16 annual tax certifications. So the other the key area is like the multiple exemptions and the deduction. So the section 10 exemption has the multiple components called the HRA, LTA, the leave travel allowances, leave encashment exemptions, and the gratuity. These components have its own criteria for the exemptions. So and next comes to the section 24. Under the income tax deductions, there is a called section 24 of the Income Tax Act 1961, so which provides the deductions related to the income from the house property. This deduction is available for the loans taken or the purchase or the construction or the renovation of the house. So under this section, the maximum 2 lakh exemption is allowed, and excess of 2 lakh can be carried forwarded for up to 8 years and set off against the income from the house property in the subsequent years. So even the pre-construction interest can also be claimed in 5 equal installment starting from the year the construction is completed. So other than these sections, we do have the Chapter 6A deductions under income tax. So it is it has a more details and more sections under Chapter 6A. Let us take the most important sections which employees are claiming as and date. So the first comes to the ATC. ATC will have the LIC premium, ULIP, mutual fund, PF or PPF. If employees invested in all these investments, then they are eligible to claim 1.5 lakh rupees exemption under section ATC. Next comes to 80CCD 1B, which talks about the additional NPS contribution. So under this section, the employees can claim up to 50K, and 80CCD 2, the employer contribution to the pension fund. So here the section will give the relief up to 10% of the basic of the salary under old tax regime, and 14% on the basic in the new tax regime. Next comes to the 80D section. So this gives the exemption for the employees or the parents if they have taken the medical insurance policy. So the premium up to 50,000 can be claimed under section 80D overall for both parents and the individual. So next comes to 80E section. So here there is no limit, but complete interest on the education loan can be claimed exemption here. So the next portion will be the 80G. This section 80G provides the tax benefit for the donations made to the specified relief funds and the charitable institutions. So there are few donations are eligible for either 100% or the 50% of the deduction. So depending upon the fund or the institution. So the cash donations are allowed only if the amount is below 2,000 rupees. And this is ATG section exemption is not allowed under the new tax regime. And the notable point here is the ATG benefit cannot be claimed by the employee through employer. While filing the individual tax returns, employees can show the proofs and claim the exemption. Next, we'll go to the ATU. So this provides the tax deductions for the individuals with disability. There is two criteria. One is if the disability is less than 40%, their employee cannot get any exemption. If the disability is between 40% to 80%, then 75,000 exemption can be claimed. And if the disability is more than 80%, then 1,25,000 can be claimed under this section. So there are a few more sections are there. So this will goes on like this. Okay. So to main challenge here is to collection and the verification of the proofs against the investment declaration done by the employee. And since the exemptions are given through the employer, and it is employer primary responsibility to thorough check all the proofs given by the employee and then give the exemption. So other than these exemptions ID deductions, Lewis, we do have the section 17, which talks about the perquisite. So these are the additional benefit provided by the employer. These are not the exemptions or the deductions. These are the incomes. I mean, apart from the income, what employee is getting as a monetary, there are a few benefits where the employer can give as a benefit to the employee, like employer contribution like PF, NPS, the National Provident Fund, and the superannuation. Here, I mean, put together these components, if the contribution is exceeds 7.5 lakh rupees, so the excess of 7.5 lakh rupees has to be considered as a perquisite and has to be added to the taxable income and arrive the tax liability for the year. And there is another thing is like the rent-free accommodation. There are few companies where they provide the accommodation or concessional rate or the free rate. So in such cases, the income tax department has restricted to the 10% of the annual salary is free accommodation. And if any excess of 10% of the salary, the accommodation amounts, then the balance has to be taxable under the purpose. So next comes to the sweat equity shares. You know, many of the companies will, are started giving the RSUs, ESOPs, and ESPP options. So RSUs is nothing but this is the restricted stock units, and which has the vesting period. So during the vesting period, the amount, whatever the RSU stocks have been allotted to the employee, it will be taxed under the purpose. So next ESOPs, I mean, during the at the time of the joining, most of the companies will give the ESOP options to the employee. I mean, even these values will be taxed at the time of the exercise. Next comes to the ESPP, and the few of the employer will give the employee stock purchase plan, where I mean employee can contribute up to 10% of the basic to the ESPP contribution and purchase the stock of the company. And those ESPP stocks will be on the discounted rate. So that discounted value will be taxed under this perquisite. So next comes to the interest-free loan. Any interest-free loan or the concessional loans provided by the employer to the employee are considered under this purpose. So loan up to 20,000 are the loan for the medical reasons, as specified under section 3A, is exempt. So the taxable value is always calculated the interest payable at the prescribed rate as per the SBI, the State Bank of India rate as on the first day of the financial year for the similar loans in the SBI. So minus the interest actually paid by the employee. In case maybe some of the employer will give the loan at the concessional rate. In that case, it is always the interest rate prescribed by the SBI minus the actual interest rate paid by the employee. So the difference amount will be added to the purchase.
Mhm.
So the other key challenge is the third key challenge is the salary structuring. In India, designing the salary structure remains a complex task, as they often consist of the multiple components and allowances specified to the region and the companies. So typically the structure will be like this: the basic usually the 40 to 50% of the CTC, and the dearness allowances will be the primarily in the public sector, and house rent allowances tax benefit based on the location and the rent paid in that location, and the leave travel allowances will be always on the tax benefit based on the company eligibility and the income tax rule. So next comes to the balancing component is nothing but the special allowance. For example, if the CTC is X amount, then initially the structure will be goes on like this: the basic, dearness, and HRA and LTA. The balance amount remains, right. That will fall under the special allowance, the flexible component. So apart from these components, as per the Bonus Act, we should pay the statutory bonus if it is eligible. I mean, if the employees are eligible, like if the salary is less than 21,000, then all those employees are eligible for the statutory bonus. And this statutory bonus should be the over and above the CTC. And next comes to the performance bonus. It varies to the companies, and company will be deciding basis on the employees' performance and the company's profit. And there are other things like the benefit, the medical insurance, meal vouchers, telephone reimbursement. So the challenge lies in creating the optimal structure that balance tax efficiency for employees and compliance with the minimum statutory requirements. So alignment with the company compensation and the philosophy as well. So the fourth key challenge is, Lewis, the India's federal structure create the state level variations in professional tax, labor welfare fund, shop and establishment, minimum age rate. The professional tax, no, the levied in about 21 states and one union territory with the different slabs and rates. The labor welfare fund is always a different contribution rate and payment frequencies. Either it will be monthly, quarterly, half yearly, or annually basis on the state regulations. And shop and establishment act, yeah, it also it has the each state its own versions of the act with specific rules and the regulations. The Minimum Wages Act will be the state level segregation. Like the minimum wages are always fixed by the appropriate government, either maybe by the central government or the state government, based on the factors like the cost of living, types of employment, and the region. So the fifth key challenge is the leave management. Leave policies must comply with the multiple regulations. The first one is the Factory Act or the Shop and Establishment. So the leave policies must be comply with the either Factory Act or the Shop and Establishment Act. So it mandating the minimum annual leaves. Typically it will be between 15 to 24 days. So next comes to the Maternity Benefit Act. So it always gives the 26 weeks of the paid maternity leave. The state specific rules like variations in the in casual leave, sick leave requirement. So next, under leave management, the national and the state holiday, it always varying by the state and sometimes by industry as well. So yeah, so these are the key challenges. And next, we can go to the recent regulatory updates, which are done recently now. So in India, payroll landscape continues to the evolve. Uh, here are the some key recent and upcoming changes. The first one is the Union Budget to 2025. So it revised the income tax slabs. The new tax regime offers the lower tax rates but eliminates most exemptions and the deductions. So impacting for the payroll calculations. So while processing the payroll, it is very, very important to go through the Union Budget updates. And there are few changes on the tax slabs under the new tax resume as well. And the standard deduction threshold also been increased from 50,000 to 75,000. So now under the new tax regime, employees the 80, the minimum threshold limit of the tax slab is increased from the 6 lakh to 12 lakh. So the TDS threshold also increased, the higher threshold for the TDS and rent. Earlier it was the 6 lakh per year, and the interest for the senior citizen it is 1 lakh per year, reducing compliance burdens. So next updates is the EPF compliance. Employer must now report taxable interest on EPF contribution exceeding 2.5 lakh annually as per the latest EPFO guideline. You know, the employee contribution is 12% of the basic, right? So that 12% of the basic, if it exceeds 2.5 lakh rupees annually, then the excess of 2.5 lakh rupees on that, if there is an interest paid by the EPFO department, right? The interest of excess of 2.5 lakh rupees has to be reported under taxable income through the Form 16 generation.
Mhm.
That is another compliance change. The next is the gig workers and the social security. The gig workers are now covered under the PM Jan Arogya Yojana, providing health insurance benefit. Employers hiring gig workers must align payroll processes with these new norms. So yeah, so there is also one more update is the maternity benefits. So enhanced provisions under the Maternity Benefit Act, including mandatory creche facilities for the establishment with 50 or more employees. So earlier this facility was not there. So now they have enhanced this provision under Maternity Benefit Act. There is also a state specific update. State like Karnataka and Maharashtra have introduced the stricter penalties for non-compliance with the Shop and Establishment Act and Minimum Wages Act as well. Okay, so the other update is the labor code implementation. The four labor codes consolidates 29 existing labor laws with the significant implications for payroll. So this is at the final stage of the discussion, which is expected to implement by end of 2025. The change or the benefit of the new wage code is it has the uniform definition of the wage across the law. So I take you through the labor laws, right? So every law has its own definition of the wages, because let us take maybe the PF calculation. As per the PF Act, it says consider only the basic and dearness allowance. But when it comes to the ESI, so it says consider the gross amount. Gross means the all the components which have been paid in monthly in nature. So now that is inform the wage is uniformed across all laws under the new wage code. Okay, so changes to the overtime calculation methodology. Earlier there was uh, few because the overtime calculation was always different from the law to law, and now they changed it to, and uniform definition will be given for the overtime calculations as well. And there is also change in the revised gratuity eligibility for fixed time employees. Earlier it was the 4 years, 8 months. I mean, it is 4 years to 40 days, but now they wanted to reduce it to 1 year, I believe. So I mean, it is at to the changes notification is at to receive. Okay. So next, other than that, we can see the adjustment to the timeline for processing full and final settlements. So the full and final settlement earlier we used to process it within 30 days from the date of leaving. But now in the labor code, we cannot we cannot take more than 3 working days after the LWD as per the new wage code. So yeah, the last one comes to the universal social security coverages. So the last update I can say is the Data Protection Act 2023 compliance. So India's largest data protection law mandates the strict measure for handling the personal data. including the payroll data storage and the transfer requirements. So there are few best practices for multinational organizations, Lewis, from my side. So based on my experience working with international companies, so here are the best practices for managing India payroll effectively. First comes is like you develop a comprehensive salary structure. So always please create a well-designed structure that optimize tax benefit while ensuring compliance. It's always better to keep it with a minimal components like basic HRA, LT, and special elements. You know, anyway, the new tax regime, in the case of the new tax regime, no exemptions and deductions are allowed as per the Income Tax Act. We used to give the more components in the salary structure just to benefit for the employee. Earlier, the old tax regime was the option, but now we do have the new tax regime, and almost 60 to 70% of the employees will opt for the new tax regime because the tax benefit is more compared to old tax regime. And government is focusing to discontinue the old tax regime after some time. So you better make it crisp and clear when you do the salary structure. That is one the best practices I can guide. And the second one is implement the robust documentation system. Maintain proper records for statutory complaints, including employment contracts, leave records, and attendance data. So it is very crucial to have to maintain all the records in place for whole year. And leverage technology solutions. Always invest in a payroll system capable of handling the India's complex calculations, multiple tax regimes, and the statutory reporting. The fourth one is the create a state-specific complex calendar. You know, India has its own state-specific complaints and rules as well. Let us take the professional tax and the labor welfare fund, right? So it always differ from the state to state. It is always better to build a detailed compliance calendar that account for the variations across operations location. So yeah, so there are another three updates I can give is the regular reconciliation process. Establish monthly, quarterly reconciliation protocols for EPF, ESI, TDS, and professional tax to avoid year-end surprises. So yeah, so next, investment declaration and management. Develop a streamlined process for collecting the tax-saving investment declarations and proof for the employees. Stay updated on the regulatory changes. So subscribe to the government notification and professional advisors to anticipate and implement changes proactively. So there are few industry specific considerations in India. Certain industries have the additional complexities like IT and ITES. So these are special economic zone eligible for the special economic zone tax benefit and flexible work arrangements, global mobility consideration. Next comes to the manufacturing. So manufacturing industries will always comes under the Factories Act. So Factories Act has its own definition of the wages and overtime regulations and the shift allowance calculations as well. So the retail industries has the variable working hours and commission structure is differ from the other organization and seasonal staffing. Next comes to the financial services, the regulatory bonus restrictions, specialized compliance requirements. So understanding these industry specific requirements is crucial for accurate payroll processing. So yeah, so with that, conclude my overview of the key India payroll challenges and best practices.
Thank you, Yallappa. I think you provided a great insight and detailed run through of the Indian payroll landscape, the multiple social security schemes and state level variations make Indian payroll particularly challenging for multinational organizations. Now let's move on to our case study to see these concepts in action. For our case study today, we're looking at a fictional tech company called Quantum Spark, which recently expanded its remote-first workforce across Hyderabad and Bangalore. Yallappa, could you walk us through the unique payroll complexities they faced in India, especially around state-specific compliance, gratuity, eligibility, and accurate statutory reporting.
Yeah. So thank you so much for raising this question, Lewis. I would be, happy to walk you through the payroll challenges that Quantum Spark encounter. As a Quantum Spark expanded its remote first workforce across Hyderabad and Bangalore, it began to face a number of payroll complexities. So many of which are quite common when managing a distributed workforce across multiple uh, Indian states. So let me walk you through some of the key challenges they faced. So the first comes is the professional tax error, so which falls under the state specific compliance. The Quantum Park initially applied a uniform PT rate for all employees, so without accounting for the differences between the state. For example, Karnataka levies 200 rupees for employees earning 25,000 or more. But Telangana, however, follows a two-slab structure, 150 rupees for those earning between 15,000 to 20,000 and 200 for earning above 20,000. So because of these differences weren't accounted for, so it resulted in over deduction in Telangana and possible under compliance in Karnataka. So highlighted the need of the state specific payroll configuration. So the next comes to the incorrect PF calculation. As I took you through the process, every labor laws has its own definition of the wage. The India labor always define the wages differently for the each purposes, right? So for PF, only the basic and the dearness allowance are considered. However, Quantum Spark mistakenly taken the PF contributions on the gross salary, so which led to unnecessary deductions for the employees and a significant administrative burden to the need for revising the ECR filings for multiple periods. So the other issue what they faced was the ESI contribution for ineligible employees. So contributions were being deducted for white collar employees who were earning above the 21,000 threshold, because ESI is eligible for employees who are earning below or equal to 21,000. So which made them ineligible for the ESI. So to add to the issue, ESI operates on the two fixed contribution period, the April to September and the October to March. So once the deduction starts in the period, they must continue until that period ends. So correction can only be applied in the next cycle. So even if the employee crossed the threshold mid-cycle, the deduction had to continue, resulting in the erroneous payments and the refund claims. Uh, the other issue was like the statutory bonus not paid. The Quantum Park also missed out to comply with the Payment of Bonus Act. As per the law, employees earning below 21,000 so are entitled to statutory bonus. So in this case, company failed to disperse the bonuses and leading to the non-compliance and the potential liability. So there is also we have identified the gratuity confusion, the eligibility confusion. There were also problems with the gratuity payments, like some employees who resigned before the completing the 5 years of the services were still granted the gratuity, violating the payment of the gratuity act. See, now while a company can voluntarily offer the benefit before the statutory limit, they cannot classify such payments as a gratuity, nor can they claim the tax exemption on them. So instead, such payments should be labeled differently, like the service bonus or any of the components which company wants to nominate to stay with the legal and the tax boundaries. So this misstep not only led to the unplanned financial outflows, but also the legal and the compliance risk as well. Yeah, they do face the statutory reporting gaps as well. The Quantum Spark also faced the issue with the Form 16 reporting, particularly regarding the variable pay and the bonuses. So performance bonus were not properly tagged. As a result, income showing in the Form 16 did not match employee payslips, so causing confusions during the personal tax filing. So this reflect a gap in pay code classification and tax map, so which can affect effective trust and the statutory accuracy. So there are also other few observations, like beyond these core issues, we also noted inconsistent documentation of the payroll policies and a lack of proactive communication with the employees regarding their deductions, entitlements, and the complaints required. So Yeah, in a closer note, the quantum spark case is a textbook example for of why companies are, especially those growing across multiple locations, need a location-aware payroll engine that understand the regional law and a strong policy enforcement for PF, ESI, gratuity, bonuses, and LWO, and robust statutory reporting and reconciliation processes. As an organization scale across India's diverse regulatory landscape, so these nuances become critical, not just for compliance, but also for building employee trust and ensuring operational efficiency.
Thank you, Yallappa. That was, again, an excellent walkthrough of Quantum Spark's challenges. I'm sure many of our attendees have faced similar situations. The multiple statutory contributions and tax regime options make Indian payroll particularly complex. So let's now move to our Q&A session to address some common questions about Indian payroll. We received several questions from payroll professionals about managing Indian payroll. Let's address some of those common questions. Yallappa, what's your response to these queries? Question one, how should companies handle the transition to the new labour codes when they are implemented?
That was a great question, Lewis. The transition to the new labor code in India is one of the most significant upcoming changes in employment law, and companies need to take a structured approach. The first is I would recommend forming a cross-functional task force involving HR, payroll, finance, and legal team. So this helps ensure that all aspects from the wage structure to compliance reporting are addressed holistically. There are a few key focus areas to plan for definition changes. The new labor code defines the wages more uniformly, which will impact components like basic pay, allowances, and bonuses. So this will have a direct effect on the PF gratuity and bonus and leave encashment calculations as well. So next key is the cost impact analysis. So the companies should model the impact of the new wage definition on the total cost to the company, especially for the roles with the high variable pay. The third key is the HR policy updates. The new code also touch on the working hours, the leave policies, and the contract employment. So these need to be aligned across the employee handbook and internal system.
Mhm.
The another key is like the payroll system readiness. So it is critical to work with the payroll vendor and the internal teams to ensure the system configuration changes are scoped and tested well in advance. The last comes is the employee communication. Since these changes can affect take-home salary, companies should prepare a transparent communication plan to employees to explain the why behind these shift and build the trust. So in short, proactive, well-governed approach can help ensure a smooth transition, minimizing disruption and ensuring full compliance when the new labor codes comes into effect.
Perfect. What are the best practices for managing investment declaration and proof collection processes?
Once again, it's a great question, Lewis. You know that is the present. I, I, I I mean the issues what most of the companies are facing. Managing investment declarations and the proof collection is a critical part of the payroll companies in India, especially to ensure accurate TDS calculation and to avoid year-end surprises for both employer and employees. So here are the few best practices that companies should follow. It is always start early and communicate clearly. So the begin the investment declaration process at the start of the financial year, ideally in the month of April or May, and share the detailed communication with the employees about what declarations are allowed under section like ATC, ATD, exemptions under section 10, and deduction under section 24, so on. The timeline of the submitting the proofs and acceptable format and the required documentation. Always the proactive communication help avoid last minute rush and increases employee compliance. So the next point is the use a digital platform. The leverage a payroll or the HRMS system that allows employees to submit declarations, upload proofs online. Features like auto verification of the PAN linked investment, upload status tracking, error notification for invalid files can streamline the process and reduce manual effort. So the third one is the validate the proofs thoroughly. So when the proof submission happens, so usually around January or the February month, so ensure that the each proof is cross-checked with the actual declaration. So deductions like rent receipts are validated against the PAN of the landlord. If the rent is greater than 1 lakh and the medical and the insurance premiums are supported with the valid receipt. So this step is vital to ensure compliance and reduce exposure during the tax audit. So the other thing is the handle discrepancies transparently. If employees' proofs do not match the declared amount, adjust the TDS in the remaining month accordingly and notify the employee. This given them a chance to plan for any increased tax deduction and avoid surprises in the final payslip or the Form 16. The last comes to the timely Form 16 generation. Finally, ensure that accurate data from the declaration and proofs process flows seamlessly into Form 16 generation. This reduce employee grievance and improve your organization payroll credibility. So in summary, automation, early planning, thorough validation, and transparent communication are the cornerstone of a smooth investment declaration process. So it not only ensure compliance, but also strengthen employee confidence in the payroll function as well.
How should companies handle employees working across multiple states in India?
Okay, so this is also, yeah, I mean, this is also a very great question, Lewis, and uh, very complex process as well. So managing employees across multiple states in India requires careful attention to state-specific laws and payroll configuration. So here are the few key points from my side. So register in relevant states. If employees are working long-term from other states, the company must register under that state's labor law and maintain state-specific compliance records. And next comes to the determine the place of employment. So since laws like the professional tax and shop and establishment and labor welfare fund vary by state, so it is important to accurately capture the employee's work location in HRMS or payroll system. Use a location aware payroll system. So it is always better to use the payroll engines should support the state-wise logic for PT, LWF, leave rules and holiday. Without this, error like incorrect deductions can occur. Uh, Ensure a smooth benefit continuity. So for interstate transfer, no, the PF, UN and the gratuity service continuity should be preserved to avoid the benefit miscalculation. Why? Because when it comes to the gratuity, the exemption which is prescribed in the Income Tax Act is a lifetime exemption, and irrespective of the employers, the exemption cannot be exceeded, which is I mean prescribed in the Income Tax Act. For that, whenever employee joins to the organization, it is better to get the I mean the prior exemption details during the onboard. So it is always better to have the continuity service details and maintain it properly. Next, document remote work policy. So define how long an employee can work from a different state and clarify any tax or the compliance impact. So in short, distributed workforce calls for location-specific compliance, robust payroll system, and a clear internal policy. This ensures both legal alignment and operational efficiency.
And what are the key considerations for handling expatriate employees on assignment to India?
Yeah. So thanks once again, Lewis, for raising this concern. I mean, asking this question. So when handling expatriate on assignment to India, so there are few key considerations like visa and FRRO compliance. Ensure employment visas are in place and employees registered with the FRRO on time. And tax residency, it is very important to determine if the expat qualifies as a resident or non-resident under the India tax rule, as this affects their income tax liability. because the resident tax slabs are different and the non-resident tax slabs are different. So next, the tax benefit and the gross up. So perks like housing and the schooling must be accurately taxed. Companies often gross up the taxes to shield the expat from the additional local tax burden. The social security, the PF, check if social security agreement, the SSA applies. If not, expect may need to contribute to the Provident Fund as an international worker as per the EPF and the Provision Act. So double taxation and shadow payroll. So use the double taxation avoidance agreement to prevent the dual taxation. A shadow payroll may be needed to ensure correct Indian tax reporting. So expect management requires a compliance across immigration, tax and social security to ensure both the legal adherence and smooth employee experience.
Perfect. And how should bonuses and incentives be handled for optimal tax efficiency?
Uh, Yeah, thanks, Lewis. The bonuses and incentives are an important part of the compensation strategy, but they need to be structured smartly for the tax efficiency. Classify correctly. Bonuses should be clearly tagged in the payroll as performance bonus or the incentive or the statutory bonus in the Form 16 or the payslip. Misclassification can create the confusion during the tax filings and lead to the company's issues. Timing matters always. So align the bonus payouts to the same financial year as the performance review cycles. Avoid pushing bonuses into the next financial year as it may affect tax brackets or the TDS calculation for the employees. So next, the use of the retention or the deferred bonuses. So consider deferring a part of the high volume bonuses over multiple years. So this helps reduce the one-time tax burden and support employee retention charge. So the other thing is the gross up where needed. For senior managements or the critical talent, companies may choose to gross up the bonus amount to deliver a net amount post-tax, ensuring attractiveness without creating tax stress. So yeah, in summary, I mean, handling bonuses effectively means a clear classification, smart timing, and personalized structuring. So all while ensuring compliance and minimizing the tax leakage for both employer and employee.
And what are the compliance requirements and around leave management in India?
Yeah, the leave management in India has several compliance requirements, Luis, and they often vary by state and applicable labor laws. So here are the essentials. The type of leave. The most state mandates a minimum number of earned leave or the privileged leave. So some also requires the sick leave and the casual leave. The Shop and Establishment Act for each state govern this. And the next is the leave accrual and the carry forward. The leave must accrued monthly or the annually as per the law. So most states allow carry forward for unused leave to a certain limit. So typically, it will be between 30 to 45 days. So the leave encashment. So at the time of the exit, employees are entitled to encash their unused earned leave. So this amount is taxable, but subject to a exemption under Section Income Tax Act 1961 for certain limits. So next is the holiday calendar compliance. So companies must provide a minimum number of the paid holidays, including national and festival holidays as defined by the state government. So on a last note is documentation and recording. The leave balances, usage, and encashment must be documented and available for the audit. The labor inspector may request these during compliance reviews. So the leave policies must align with the state laws, be well documented, and supported by the systems that track and report uses correctly to ensure compliance and fairness.
Right. And what are the key considerations when setting up a payroll function for the first time in India?
Okay, that's really a great question, Lewis. Setting up a payroll function in India for the first time involves both the strategic setup and strict compliance. So here are the few key considerations Lewis, the entity registration and the labor codes. The first ensures the company is registered under the key labor law like Shop and Establishment Act, Provident Fund, ESI, uh, Professional Tax, and Labor Welfare Fund where applicable. Next, choose the right payroll system. It's always better to select a payroll platform that can handle state-wise compliance, tax calculation, payslip generation, statutory filings like PF, ECR, PF, ECR, ESI returns, and the TDS statements. So the other thing is the employee classification. So you clearly define the employee categories like permanent employee or contract employer interns and structure the salary components accordingly, especially for the tax efficiency and benefits eligibility. The other thing is the setup for statutory deductions. So configure the system for the PF, ESI, income tax, gratuity, and the bonus act compliance from the day one to avoid the retroactive corrections. So policy documentation will also play the vital role here. To create and communicate the clear policies for the leave reimbursement, variable pay, and exit settlements. So the last thing is the monthly and the annual complaints calendar. So build a monthly checklist regular for the regular filing like the PF, ESI, TDS, PT, and the annual Form 16 distribution. So there are a few labor laws or the act says the annual filings as well. So whatever the monthly returns have been filed, then those consolidates and we need to file the annual return before closing the financial year. So that needs to be taken care and should be maintained under the compliance calendar checklist. So the goal is to build a compliance scalable and transparent payroll setup that align with the India's complex labor system.
Thank you, Yallappa. I think these insights are incredibly valuable for organizations managing Indian payroll. I think we've got time for one final question. And what trends do you see emerging in Indian payroll over the next few years?
Oh, that's a timely question, Davis. I mean, we are seeing some clear trends shaping the future India payroll. Let me highlight a few key ones. Digitization and the automation. The companies are moving towards the cloud-based integration payroll platform that handle everything from attendance to the complaints filing. So reducing manual errors and boosting the efficiency. Increased focus on compliance analytics. With the frequent updates to the labor law and the tax norms, so payroll teams are using compliance dashboard and analytics to monitor risk trends and audit readiness in real time. The other thing is the unified labor code when implemented. I mean, still it is not been implemented. So once rolled out, no, the new labor code will simplify, but also standardize the definition like wages and eligibility, forcing companies to revisit how salary structure are built. A rise of gig and remote work models. So as more companies embrace gig workers and hybrid teams, so payroll system will need to adapt to multiple state and non-traditional employment models, so including freelancers and contractors. So employee self-service and transparency. So employees expect the greater visibility into their pay and taxes and the benefit. So looks like employee portals and mobile access to payslips or tax projections are becoming standard nowadays. And integration with the finance and the HR tech. So payroll is no longer standalone now. So it is increasingly integrated with the HRMS, accounting and compliance system to streamline reconciliations and improve accuracy. So the future of payroll in India is tech-driven, compliance-focused, and employee-centric.
Again, thank you for those answers, Yallappa. I think you've certainly provided a really good insight there to some questions that were posed, and I think the complexity of Indian payroll certainly requires specialized knowledge and careful attention to both the national frameworks and state level variations. But that brings us to a close. It's a wrap on our Indian session of Global Pay Fest 25. I think the viewers would agree, Yallappa, you are certainly an expert in your field. So a huge thank you for sharing your expertise, the unique challenges of Indian payroll, both from a multiple statutory contributions to the state-specific variations to complex tax calculations. It certainly makes for one of the more sophisticated systems globally for multinational organizations to navigate. To our audience, thank you again for joining us for this important stop on our 24-hour journey around the world of global payroll. Remember that all sessions from Global Pay Fest 25 will be available on demand after the event, so you can revisit this content and catch any sessions you may miss. Coming up next, we'll be heading to the United Arab Emirates, another unique system with its own set of challenges and best practices. Please stay with us as we continue our global payroll journey. Yallappa, thank you once again for your time and expertise. Do you have any final words for our audience before we close?
Yeah, thank you, Lewis, and thank you to everyone joining us today. It's been a pleasure to share insight into managing India payroll, a system that, while complex, offers immense opportunities for organizations to ensure compliance, efficiency, and employee satisfaction. So, as we discussed, the key success lies in being proactive. So, whether it is preparing for the upcoming changes with the new labor codes, uh, sim streamlining the process for investment declarations or ensuring compliance across multiple states and employee categories. So by focusing on technology, communication, and staying updated with the compliance requirement, so organization can navigate these challenges effectively. I encourage all of you to take these insights back to your team and start thinking about the best strategies to implement. The landscape of the payroll is evolving, and staying ahead of these trends a key to long term success. So thank you once again for your time and have a good day.
Thank you, Yallappa. So this concludes our Indian session of Global Payroll Fest. See you on the next stop of our Global Payroll Tour.